Shares of Ford are struggling against a union strike and have basically gone nowhere for 40 years. But the next 5 years could see a massive run in revenue and lower costs, pushing the stock to between $50 to $84 a share. That would be a return of 600%. Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for a very special valuation video. I know shares of Ford are very popular with the dividend investors out there. I'm about to show you a price upside on this valuation that could make for very strong returns as well. Don't forget to join the community by tapping that subscribe button so you don't miss a single episode. And check out tomorrow's video where I'm going to be ranking the top 20 monthly dividend stocks. First though, if you want to see the stocks I'm buying for the next 30 years, my forever stocks, check out the link I'll leave in the description below. This is a free report I put together with the Motley Fool. The 5 stocks I'm buying for the next 30 years. You'll see that first stock immediately, then get the next 4 by email. The report is totally free. There's no obligation to buy anything, so look for that link in the description below. Back to Ford though, and shares of Ford Motor jumped post-pandemic with the rest of the market, but have gone nowhere since. In fact, we've seen short bounces on good news in EV production, but it's always been quick to reverse and is now under $13 each. That means the shares have basically gone nowhere for the last 40 years. Now Ford and the other 2 legacy US automakers, GM and Stellantis, are locked in a battle with the United Auto Workers and a strike that started this week. The UAW wants a 40% pay hike and a 4-day work week for its workers, among other asks. It's since come down to about 30% hike, but the sides are still pretty far apart, and 13,000 UAW workers walked off the job earlier this week. And with the record union strikes this year and that tightness in the labor market, the legacy automakers are probably going to have to agree to some kind of pay hikes right in the range of 20 to 30%. That's going to put it further disadvantaged to Tesla in production. Tesla pays just $45 in wages and benefits for its non-union labor. That's just 2/3 what Ford and the big 3 automakers pay at around $66 an hour. And an increase of even 20% will take that number to $80 an hour, almost twice what Tesla pays. And you see that really come out in the profitability for the automakers. If we go over here to the statistics tab on Yahoo Finance, we can scroll down here. Ford Motor reports an operating margin, that's right down here, operating margin of just 4.5%. That is the profitability after paying all the operating expenses like wages. That is a third the operating margin of 13.5% reported by Tesla because of that non-union production and something I'm going to talk about later. Tesla is 3 times more profitable than a company that's been making cars for over 100 years. Now you would think that difference in profitability would doom the big 3 car makers like Ford, but there is one factor that I'm going to show you next that could make this one of the best investments over the next 5 years. The F-150 truck has been the best-selling truck in America for 46 straight years, selling over 640,000 trucks just in the last year alone. And it's beaten every car model for the best selling over the last 41 years. Ford is transitioning its F-150 to an EV version, the Lightning model, and while there have been challenges, I'm going to show you how this alone gets Ford stock to as high as $84 a share. Now Ford has started to scale production quickly and has a target annual run rate of 150,000 trucks by this fall. Lower prices recently have helped drive a 3x increase in web traffic and 6 times increase in orders, so we know the Lightning is holding on to that brand strength, that brand identity of the F-150, bringing truck owners over. Against that, Lightning sales are still just 1.6% of total F-150 truck sales. So as long as it can keep that brand strength, that brand loyalty for the truck, bring those costs down and work on some of the other issues that we'll talk about, Ford should have a very strong position in the EV market. Now, the electric vehicle division of Ford is still working on its production costs, much like we saw in Tesla in those unprofitable years. So many years just trying to scale that production higher to bring down the cost per vehicle down. But scale is showing through in the lower cost per vehicle. Ford did recently announce a price cut on its Lightning from $6,000 to $10,000 off. And when we look at what is possible for scaled production, Tesla reached about 150,000 cars a year in Q1 of 2018 and has grown production by 67% annual pace to 1.7 million cars by the beginning of this year. Now, I'm not going to bet that Ford can keep up that pace of production growth, especially with its union problems, but even at a 50% annual production pace on a 150,000 target this year, it could easily be producing about 700,000 EV trucks a year, meeting almost its full F-150 requirement at demand within about 4 years. And next, we'll work through that revenue bump and the price target for Ford, but there is reason to believe that that shift to electric vehicles will also help boost profitability for Ford and minimize its union troubles. Traditional combustion engine cars have about 2,000 moving parts versus just 18 in an electric vehicle. All said, it takes about 6.2 hours per vehicle to assemble that traditional car and just 3.7 hours for an EV. So that shift to EV trucks will mean lower production costs and fewer workers. GM has already closed 3 plants this year. Mercedes-Benz announced 10,000 job cuts, and Volkswagen's Audi unit, 7,500 cuts, all phased out as they shift to the electric vehicles. And if we look back here, remember that stellar 13.5% operating margin for Tesla, that profitability, it was negative as recently as 2018, but look how quickly it grew. As production scale grows, that cost per vehicle decreases, and for Ford, that lower cost is going to come in on multiple factors. Not only will Ford be able to decrease its cost per vehicle just in that higher scale of production, but also in that shift to production of more electric vehicles. Much of the EV production is in the South, where it's more non-union labor. This could further increase profitability for the company. Now, of course, there are still issues with the Lightning that Ford still needs to work out. A battery problem stopped production earlier this year, and the Lightning has a 14 cubic foot trunk under the hood for storage, but only comes with a 5.5 foot bed, whereas the F-150 has options for 5, 6, and 8 foot beds. And even after this year's price discount, the Lightning is still about $20,000 more than the standard F-150. There are federal rebates you get with a Lightning, but Ford is going to have to bring down that price down further to get more of its truck owners to shift. The Lightning does win out where it counts though, with acceleration and power with up to 580 horsepower and 775 pounds-feet of torque versus just 290 horsepower and a V6 for the standard F-150. And as Ford scales into that higher production for the EV model, just like we saw Tesla do with its cars, I think it works out a lot of those issues and gets more of its F-150 truck owners to shift into EV. And so then working through these numbers, if we just apply that revenue boost and an increase in profitability through the transition, we can get an estimate of fair value for shares of Ford over the next 5 years. For revenue, the current forecast on Wall Street is for 4.5% annual growth to $186 billion in 2027. Now, this does not give the company credit for that shift to EV, and I could see Ford easily hitting 6 or 6.5% annual growth to $204 billion over the next 5 years. We see the operating margin was as high as 8.9% in 2017, and that's a reasonable target as Ford scales production on the Lightning. The margin might take a hit this year and next when that union contract is worked out, but should jump over the next few years. And on top of that operating margin, I'm estimating a 5.5% net margin for 2027. If we look at the valuation now, Ford stock is trading now for 12.2 times on a price to earnings basis and 0.3 times its revenue. But we see here in this Morningstar data, it's been as high as 30 times PE and 0.62 times sales in 2021. Of course, Tesla valuation is all the way up at 78 times price to earnings and 10 times its revenue. So as Ford transitions more of its production to electric vehicles, I think at least a 30 times price to earnings and a 1x or sales revenue multiple is fair. So on our $204 billion revenue estimate by 2027 and that 1x sales multiple, we get a $200 billion market cap or a share price of $50.97 each. That is a solid 313% return from here. It's even higher on that earnings multiple though. On $204 billion in revenue, 2027 revenue, and a 5.5% net margin estimate, we get $11.2 billion in 2027 earnings. Times that 30 price to earnings ratio is a market cap of $336 billion or an $84 share price and a return of 580%. I believe that is a conservative estimate and the shares could go up even higher if the transition is faster, but you do need to understand there are risks here. The biggest risk obviously is just the UAW and those wage increases it can squeeze out of the company. That's going to lower the profitability for Ford probably this year and next, and it needs a plan for shifting more of that production to electric vehicles so it can compete with those lower cost car makers like Tesla and Rivian. With over 40 years of being a best-selling truck, I'm not worried that the F-150 is going to lose that status, but Ford does need a reason or to be able to convince owners that they need to shift to the Lightning as well. Get your free report with the link below, my 5 forever stocks, the stocks I'm buying for the next 30 years. Or click on the video to the right where I break down the $2,000 price target for shares of Tesla. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.